we will straight start go to the lesson. Now I actually emailed this in the morning. I don't know whether you had any time to go through this calculation, but we will quickly go through this, and I want to discuss about the government securities. We have discussed bonds and bills. Now I want to discuss about repos and reverse repos today, and discuss a bit on SLDBs, and also because now SLDBs and Sri Lanka sovereign bonds, if you take, they are also bonds, right? They also come under bonds, and the calculations are more or less similar. ISBs, of course, that is international sovereign bonds, of course, they have the same calculation as these normal bonds, because they are bonds issued by the government of Sri Lanka and listed in some stock exchange, right? Usually, if you go to Singapore Stock Exchange, you can get the quotes, right? They are listed there, and some financial sites also give some information of these ISBs. But we will first finish this off. Now, yesterday we calculated up to this point, 1,550,250 accrued interest we calculated. Then we calculated the N value, and we discussed that how many times from future that these cash flows has to come to the present, and then by doing that, those cash flows will now when we apply our principle on this, that is the present value of future cash flows, or present value of future money, right? So when we apply that, you will get the actual
presentation on karo. Presentation on karo.
All right. Sorry. Now you can see, no? Excel sheet can be seen, right?
Yes, I can see.
All right. Okay. Thank you. Thanks for feedback. So now, so we were discussing about this actually, what is in this Excel sheet. So now if you calculate, I am not going to calculate this actually, all these cash flows, the present values. Now you know the cash flows. You know all these cash flows are, we have 1.750. That is the coupon. So we have coupon payments, 1,750,000, and we have 8 cash flows like that, right? We have 8 cash flows like that. So we will paste it, and then the last one, you get another cash flow, that is 50 million, right? So now what we have done here is what we have done here is we have calculated the present value of all these cash flows, and we have arrived at answers, right? We have done about, say, maybe about 4 questions like this earlier. So we have arrived at the answer, and we have got 48,101,461.02. This is the consideration for this bond. This is the amount that you have to pay to buy this bond on this date, on 11/8/2010, at a yield of 9.32. So the deciding factors are the settlement date and the yield, right? And obviously the quantity, but quantity we know here, the quantity is 50 million. So so these are the cash flow present values, and you get 48 million net present value. We call this net present value, right, of future cash flows. So one by one only we have done. There are formulas that you can do the entire thing together, but they are a bit complex. No need for going for such complex things, because we have this simple formula: PV equals FV divided by 1 plus R into the power n, right? So then what you get here is the dirty price. Usually we quote the price for 4 decimals, so I have put 96.2029 as the dirty price. Now if you want to find the clean price, you have to minus the accrued interest from this clean price. But only thing, now you have this for 100 units, right? You have this for 100 units, so you have to get just a minute, slide difference. You have to get the full price for the. Why now we have got the price here, no consideration. Why do I want to calculate it again? Because now in the market norm, the market norm is that we get the price for 4 decimals. So we first calculate the price for 4 decimals, and thereafter we do the calculation to make it fine tuned. So if you calculate this from the bond cal also, you get the same answer. You can do it and see whether there are any differences. But now if we do 96.2029, right? 96.2029 into 50 million, right? Calculate it and see 50 million. It will give you 48 million and divide by 100, because 100, no, 48 million, 101, 450. This amount it will give you, right? So you have to you have to deduct 1,550,250, no? So you will get 46. This you have to multiply by 100. Now, since there was a slight, difference in the accrued interest, because we have taken a wrong figure yesterday, 5120,000. So this is the amount, right? So you get this amount. Sorry, 10 is. Right, so you divide this by 100, and then you divide this by 50 million. So now when you deduct this, you get this figure, like you get this figure 48,101, 450. You deduct 1,550,000, 250 from there, right? I'll calculate it and see whether it's working again. So you can straight away do the calculation here. And it's this. Now I am doing one step here, right? So you get this amount 46,551,200. So this figure you divide by, I'll calculate here because that figure was wrong. This figure you divide by 50 million, right? 50 million you get here. So by 50 million, right? So you get 93.10, but this is for 1 unit, no? So for 100 units, you have to multiply it by 100, right? Why? Because we just calculated for 1 unit. So usually the market quotes for 100 units. So we calculate for 93.1024. So this is the answer. You can go through this, since we you can identify if there are any mistakes. We have done this part this part yesterday, and we have arrived at the clean price now. So when this why clean price is now now all the deals, why do we indicate the clean price? Now usually the clean price, now there are so many ways in recording these transactions. Now this is the way how we calculate it, right? So now when you take the clean price is the price at which you purchase this bond, right? The accrued amount, accrued interest part is additional amount that you pay because you get that other person's interest, right? So now if you calculate capital gain out of this say suppose if you sell this bond later on and if you happen to if you happen to definitely you will be selling it at a different price, right? So if your clean price is higher than this, when you sell this one, now here just assume that we bought this bond, and now later on in a future date you will be selling this bond. So now you have a clean price, you bought it at 93.1024, but suppose you maybe say you sell this at 90.94.1825, right? So I just put a figure here, 94. So what is your capital gain? Your capital gain is this clean price minus this, right? This was your purchase price, no? This was your purchase price. So your capital gain is 1.0801. So this multiplied by the quantity, right? You get the full capital gain. So the difference in clean prices are the capital gains, right? Capital gains. And now only thing is there can be holding cost here that I will now, since this we came to a point where now I explain a bit on the accounting entries. Now we will be doing I will be doing a lesson on the portfolio segregation, like how the institutions will keep their portfolios, like I mentioned earlier, this HTM trading and AFS. So there I will explain you further on this how you account. I mean, it is not really important to know, but then it's good to know, because it's it is yeah, there are different ways of recording. So the institutions can adapt within the standards different ways of recording, but standard, there are accounting standards which will which gives you the guideline. So we will go into that area later on, but for the time being, what I say is these two clean price differences are the capital gain that you or capital, it can be a capital loss even. So if this figure is maybe 90 something, then it's a minus figure. You see, it's a minus figure, that is a capital loss. So you account this as a capital gain or a capital loss, right? So now this brings us to the end of this calculation of bond pricing, right? So if you need to ask any question, you may ask now. Otherwise, I can move on to the repo, reverse repo, but their calculations are very, very basic calculations. So And also, like, if we go back to our presentation, now at the so we actually at the inception, I mentioned that I will be covering these areas with regard to the calculation. Now we did treasury bills, treasury bonds, and we have Sri Lanka development bonds and Sri Lanka sovereign bonds. So these two are also these two calculations also same as the treasury bond calculations. Only thing, the recording is a bit different in Sri Lanka development bonds. That also I will explain you when I do these portfolios. So Sri Lanka sovereign bonds are the same as the calculation is as the same as treasury bonds. So Sri Lanka sovereign bonds are the bonds which are issued outside Sri Lanka and listed in some exchange. So now I will move on to repo and reverse repo, right? Repo and reverse repo, and we will try to cover all the, because reverse and reverse repo are very common in Sri Lankan market, and most of the customers know. Sometimes the counterparties, some customers know much better than us, right? Because they have been doing this for a long time, and there are in this reverse repo and repo market, if you notice, we have only a limited set of customers who are engaged in this investment type. Even treasury bills, treasury bonds, repo and reverse repo. So, but only thing, as a market to develop, you can educate the people, like to come into this market and invest in bills, bonds, and other instruments. Of course, development bonds and sovereign bonds also, if they are eligible to do that. Yeah, Sri Lankans, there are eligible Sri Lankans who can purchase Sri Lankan development bonds and Sri Lankan sovereign bonds. So this will enhance the scope of the institutions who are offering these, and also as money brokers, could be beneficial for you all to have have volumes, right? So I will go to this. I have added a few slides here. After the presentation, I will I will share them with you. Now repurchase agreements, we call them repurchase agreements. Why? We exchange bonds with the with the promise of doing the same reverse process again in a future date, or rather we have a promise to now someone will give you bonds and in return of cash, and in a future date that person will give you cash and get back his bonds, right? So repo is an agreement to exchange bonds for cash and reverse the process in future. Right? So so one person, there will be a person who is giving money, and there will be a person who will be giving bonds, or it can be different other securities. Now, although I mentioned here bonds, now this is a repo agreement. If you take bonds, it's a repurchase agreement, or repo on bonds actually. But you can do this on bills as well, right? Treasury bills or any other acceptable security. Now we had some time back, commercial paper you can use. You can use other securities like, you know, trust certificates or some. So if the parties agree and if the regulator allows, right, always now these agreements are, you know, these transactions are covered by regulators, you know, directions, as well as the market practices and norms. So sometimes repo on bonds, right? Repurchase agreement on bonds will be more attractive than other securities. So that is why we always find bonds uh, uh, for bonds in bonds given as security for repo transactions. So repo transactions are maybe 99% of the Sri Lankan market repo transactions are based on bonds, right? There are some bills and other securities, you find very seldom those things. But bills, of course, you can do, but only issue here is the calculation basis depends on the basis of the instrument, right? So if someone now you know Sri Lankan rupee bonds, the calculation basis number of days, the day basis is 365. But bills, if you take, for instance, bills are 364-day basis. Bonds are 365-day basis and bills are 364-day basis. So if you do a repo on bills, you have to use 364-day basis calculation. So that is the very correct way to do that. But I have, you know, I have found some repos. If both parties are agreeable, then you can decide the day basis accordingly. Like usually, day basis here is 365-day basis, right? So to avoid any ambiguity and, you know, any complexity to this, we usually use bonds, because we the institutions who are engaged in repo transactions are having huge bond portfolios. Basically, most of the institutions are concentrated on bonds rather than bills, right? So they buy and sell bills mainly, I would say, mainly for, you know, customer transactions. And maybe there are huge portfolios for proprietary or rather their own investment purposes. But bonds are the more popular in Sri Lankan market, right? As a government security, treasury bonds. So these treasury bonds can be given as a security, or given as securities rather. We don't call that we do a lending, and, you know, this is not really a lending against some security. So in exchange of bonds for cash, so you give these as securities for the transaction and then get cash, right? So we will go into further deep from the next slide. So now I have categorized here two types of repurchase agreements: classic repos and sell and buyback repos. Now, what is the difference between classic repo and sell and buyback? Now, classic repos are the repos that we usually find in our market, right? We usually find in our market, and very popular repo type here in our market is classic repo. We will go through what the features of classic repo. But what is sell and buyback? What is sell and buyback? Now, you know this when you do a repo, you get access to the government securities. Actually, it is short-term access to government securities. No. Now, say suppose if a person comes and that person wants to invest in a repo, right? That person wants to invest in a repo, and he gives the bank money, right? He gives the bank money and he says, I want a repo for 7 days. He will say, I want a repo for 7 days. Now, then what happens? He will get access to a government security, because in exchange, the bank will give him a bond, right? Bank will give him a bond, right? The calculation methodology or calculation, what is the quantity that we should give, we will look into that later on. So the repo, for the money given by the customer, we give that money, we give him a bond, right? So that person who invest in this repo will get, very short-term access to the government securities. When you say access to government securities, mainly like, okay, the stability of the instrument is there, no, the risk level of the instrument is there. So we consider the government securities are zero risk instrument, right? So depending on the country rating, the other countries may, give a rating, a different rating for our government securities, but that is a different thing. But any within a country, for that matter, any country, the government securities are the instrument which has very low risk, right? Very low risk. Now this also I need to clarify a bit. When you say the risk, it is the credit risk, right? It is the credit risk. What is credit risk? Credit risk is the risk that there can be a default. That means you will not get your money at all, and apart from that, sometimes there can be a delay in getting the payment or getting paid back, right? So the credit risk is, now in government securities, we consider credit risk as zero, right? But what is the risk available for this? Now, give me a minute. Excuse me. Hello? Yes. Hello? Yes. Yes. All right. Okay. Okay. Thank you. Yeah. Sorry. So we consider government securities as zero credit risk. Government security has zero credit risk instrument. But what is the risk available with government securities? Can someone tell? We were actually our earlier lesson was based on that, although we didn't mention that. What is the risk involved in government securities? Can anyone answer? What is the name for that?
Is it market risks?
Yes, it's the market risk. Market risk in the sense the fluctuation of market rates, right? Market rates. Now, when we say yield to maturity is based on the market rates, no? So market rates. So the market has a rate. Now, these rates are actually flowing down from the policy rates of the central bank. So that means the policy rates are based on the government thinking of interest rates, right? So government's policy on interest rates will reflect in policy rates, and this will come down to the market rates. So market rates, fluctuation of market rates is the market risk for these government securities. Why? When the rates fluctuate, the prices move up and down. No, if the rates come down, then the price will move up, right? And if the rate goes up, then the price will come down. So there's an inverse relationship, inverse relationship between the market rates and the bond prices, right? So so what happens is, so we consider these now if we take if we keep this market risk side apart, there's this credit risk wise, the government securities has zero credit risk, right? So zero credit risk. So now this investor who is investing in a repo will get access to an instrument which has zero credit risk. So that is one advantage actually. Although we don't see that, I mean, we see usually in the repo market, we see the interest income only most of the time, right? And the easiness of making the investment and getting it back like that. So the process is very fast, right? So that only we are usually we looked at that aspect, but other aspects are there. Now going back to these types of repos. Now we have classic repos and sell and buyback. So classic repos are the ones we do every day. Like those are actually very common in market. I haven't seen a sell and buyback for a long time because market doesn't do sell and buyback now. But then there had been few occasions where we came across sell and buyback, repos. What is sell and buyback? So sell and buyback is, it's like you are selling the security and buying it back, right? The classic also has that feature, but in sell and buyback you sell it for the market yield, right? And you get it is like an outright sale, right? It is like an outright sale. You know what is outright sale? No, outright bond sale is you sell it like, we calculated earlier these prices and all these things. So you will be selling at that price. You will be selling at that price, and then you will be buying it at the price agreed upon. So then it's like two outright transactions, outright sale and an outright purchase, right? So so that is the main difference, and due to that there won't be any margin attachment to sell and buyback, right? When I say margin, you will wonder what it is sometimes if you are not very familiar with this word. Margin is the haircut. Now the familiar word is haircut, right? So sell and buyback will not have any margins because no need, because it is done. The transaction is will be concluded at the rate, the market YTM, and the price you pay or you get is the same as an outright sell or a buy. So first, now if we are doing it, so you sell the securities and then you buy back the securities, right? So that is why it's called sell and buy back. But classic repo is the most common type here in Sri Lankan market. So we will go through some of the features of these repos, right? So repurchase agreements, classic repo, right? The collateral is exchanged for cash at an agreed rate of interest. Now in definitions, we use this word collateral, right? We use this word collateral, but in fact, it's not a good word, but for the explanation purposes, we use that, because this is not a lending. This is not a lending which we do for by taking a security, right? By taking a security in the sense, by taking a collateral. This is a exchange of securities for cash, right? So there's a slight difference in in these terms, giving a loan. It's not like giving a loan, right? Although it has the features of a loan, or it has the features of borrowing, right? So we call sometimes repo borrowings, right? So sometimes even these reports we prepare, we say repo borrowings, correct? But repo is a slightly different instrument, which differs and which has some features which are different from a normal day-to-day loan, or a lending or a borrowing. So title of the collateral passes to the new holder, right? So when this exchange of cash to the securities, what happens is the title of the securities passes to the new holder. Now, if we go to the fourth point first, we will discuss this first, then it will be easier for you to understand the rest. The lender of bonds is doing a repo, and lender of cash is doing a reverse repo. So these repos and reverse repos are two sides of the same transaction. Same transaction. Now say like as banks, we do both repo and reverse repo. But a very familiar one for the customers, they say we want to do a repo, right? When they want to do a repo, that is, in fact, they give us cash and we give them securities, right? We give them securities. Now, really speaking, now we are the party who is giving cash on repo side, right? Now, say bank A is giving cash to bank B, and bank B gives securities to bank A. So lender of bonds, who is the lender of bonds? The bank B. So in this case, the bank B is doing a repo, and bank A is the lender of cash. Bank A gives cash to bank B. So it's doing a reverse repo. Basically, the person who is giving cash is doing a reverse repo. So some customers, as I said earlier, they are very familiar with this. So they come to a branch and they say sometimes, okay, I want to do a reverse repo, right? I want to do a reverse repo. So reverse repo means he is giving us cash, right? Now another customer can come and say, I want to do a repo. Same thing. But this first customer is a smart person because he has been doing this for a long time. He really understands his side of this transaction, right? So what we do when we accept cash, right, and give securities to a customer, we do the repo, right? When we accept cash and when we give bonds to the customer, we do the repo, right? Usually now in most of the banks, we have a branch network. So most of the customers come and they want to invest their money in repos, right? Now we say repurchase agreements in common, right? We say repurchase agreements in common. Why? This is one instrument. Has two sides, the repo side and the reverse repo side, right? That is why now that when we want to do get into a repurchase agreement, we need to sign a document called master repurchase agreement, no? Master MRAs, no? Master repurchase agreements. So all the counterparties who are dealing with each other, they sign repurchase agreement, master repurchase agreement to cover this transaction, right? Legally. This was actually introduced recently. Earlier, there wasn't such MRAs in the market in Sri Lankan market practice. But now it's a requirement, regulatory requirement to have master repurchase agreements if you want to enter into a repurchase agreement. So why now they don't mention about reverse repurchase agreement, master repurchase. Why? Because the repurchase is one transaction. So you get two sides, the repo side and the reverse repo side. So person who is giving bonds is doing the repo. Who is giving cash is doing the reverse repo, right? So basically when we do, when we accept money from customers and give them securities, so they are doing actually reverse repos. They are doing reverse repos, although we call it in common repos, right? But if you do with a counterparty, then in their deal, they will have a reverse repo, right? Reverse repo, and then other side, they will have in their deal repo. So now going back to the second point, now I have mentioned here the title of the collateral or the title of the security passes to the new holder. How does this happen? Now we have, we have this central depository system in our, settlement system, that is Surplus Security Settlement System, SSSS, which came into effect in 2004, right? 2004 February, right? So before that, we were, having all these government securities in paper format, right? So now it's in, electronic format, so it's easy to do the transactions. So now what happens is, now when we do a repo with a customer, we transfer the securities, we will call them bonds from our account to the customer account, right? Our account to the customer account, which is in the CDS. Now, as you all know, the CDS is not the CDS with the share brokers or rather the Colombo Stock Exchange. We have this system in Lanka Settle system, and that is SSS system, Surplus Security Settlement System. So the securities will be transferred to the cash lender's account, right? The CDS account. And what happens? But in between, if he receives a coupon, right? The coupon payment is not his actually. That is the lenders. Lender means the person who is giving. So the benefit of the coupon. So if he receives a coupon, the coupon will go to the original person, not to the new holder, right? So because of that, the lender of bonds will get the coupons. Lender of bonds, that is the person, that is, if in this case the bank will get the coupon, right? Coupon payment. And the person, our customer who gives us cash, has no entitlement for the coupon. So what we do is to avoid this, because now when it is now if it is a customer of your own bank, right? If it is a customer of your own bank, then anyway you will be getting the coupons in your central bank account, so you can always have your coupon. But if you transfer the security outside, that outside person will be getting the security, right? Sorry, the coupon. So it is a matter that we need to tell them to give us the coupon. So to avoid that, we when we lend bonds, or rather when we transfer securities, we transfer a security which has no recent coupon, right? Which has no recent coupon, right? Just give me a minute. So if you have any questions, if my explanation is not clear, just ask, right? Now, so benefits of the coupon will be remain with the person who has originally transferred this security to the reverse repo person's CDS account, right? And the next point here is initial and variation margins apply, right? Initial and variation margins. What are these? Now, initial margin is the now when we give a security to a customer, right? We need to cover his cash value, right? Now we take money and we give a security. Now this is a repo transaction. To complete this transaction, to enter into this transaction, you should have a master repurchase agreement, and then we need to agree on I am talking about these classic repos. We need to agree on a rate of interest, right? At which now although we say rate of interest, actually you are selling at a price and buying at a price, right? But then to calculate the benefit, we arrive at a interest rate. So we have to agree on interest rate. And now the directions say it is not enough for you to cover only the capital and the interest, right? Because there can be a price, or there can be a value change in the bonds that you give to the customer, right? Now I'm talking about the repo we are doing with the customer. So we give the customer to cover his capital, we will say 100,000, and we will say 10% interest for easy calculation. So 110 is the maturity value. So we will be giving 110,000 worth securities to him, right? But the requirement is not that. So this 110,000 worth securities are not enough for this transaction. Why? The 110,000 worth securities can fluctuate in its value with the fluctuation of market interest rates. That is why earlier we discussed that government securities are exposed to market risk, right? Government securities are exposed to market risk. So if the market rates go up, right? If the market rates go up, what will happen? If the market rates go up, then the security value will drop, no? The value of the security drops. So then that value will not cover the cash lenders full amount, right? So now say if now we in our example we said 110,000 we gave, right? He lent us 100,000. So with the interest 110,000, right? So now with the fluctuation of the interest, or rather with the increase of market interest rates, right? The value drops, we'll say the value drops to 105,000, right? 105,000. Now our security which we gave to this customer has a value of 105,000 rupees. So what happens now? Now he has a risk exposure there, because his money is not entirely covered by this security, because security has gone down in its value, right? He has lent 100,000 plus interest 110. Now it's 105. Why? Now, sorry, now the security value is 105. Why? The market interest rates have gone up. So the market interest rates, if the market interest rates further go up, right? What happens? Then it can come down even below the cash value. Forget about the interest, it can further come down below and can go down below the capital amount that this customer has given to us, right? So to avoid that, they have introduced an initial margin. So they say you have to cover, if you want to cover 100%, sorry, if you want to cover 100, you have to cover 110, right? If you want to cover 100,000 cash, you have to give 100,000 cash, in the sense, don't forget the maturity value. Now time to time these regulations have changed. Like earlier we covered only the cash value. Now later on, now we cover the interest component as well, so that then it is the maturity value of the repo, right? And the haircuts also, the initial margin also vary according to sometimes the maturity of the bond which we are giving, right? So it can there's a regulation, plus the people can agree on the initial margin, the repo and the reverse repo, both parties, or rather lender of bonds and lender of cash can agree upon this initial margin, right? We will say that we have agreed, or we have gone by the regulation, and we have kept, we will say 10% margin, right? So then, so the rule is, now you have to maintain all the time a 10% margin. 10% margin is, you are covering this transaction 10% more, right? Say if the value, we will say if the maturity value is 100,000, we will say 100,000, you have to give securities worth 110,000, right? So that is, you are covering 110%. So the margin is, or the haircut is 10%, right? So now in here, so everything is okay. Now the initial margin has given, and you have covered 110%. So now suddenly, if the market rates go up, the government security market, bond market rates go up, what will happen? This 10% haircut will come down, no? Because now the value of your bond is not 110,000. Value of your bonds which you have given for this repo transaction is not 110,000. It's less, because the market interest rates moved up, and eventually when the market rates go up, your bond portfolio will fall in value, like, so it has come down, the value has come down. So now you need to top up the margin, or rather you need to top up to the original position. So you have to bring more you have to bring more or rather transfer more securities to the customer's CDS account, right? To bring it to the required level. You have to transfer them to the customer's account to bring it to the required level. So here, this is called the variation margin in our, our repos. So variation margin, when we say variation margin, so now in certain cases, when you say variation margin, so it is actually it applies. Now we do this. We do this. We do this as soon as it comes below the required margin. But the actual term variation margin is that you have a lower limit. You have a lower limit. You mark a lower limit, and then if the value drops below that margin, then you top up again, right? But in our case, our variation margin is the haircut. That is the initial margin is the variation margin as well, right? So if it comes down below 10%, we straight away top up. Now, now when we do, like, maybe in derivatives, I should not bring that example because we haven't done derivatives, but there are instruments where you have an initial margin of 10% and a variation margin of 5%. So if the value brings, if the value drops below 5%, then you have to bring more securities like that. So, but in our case, the variation margin is more or less the haircut percentage, right? Haircut percentage, that margin. So initial and variation margins are more or less the same in this instance in our classic repo, right? So we will move on to the next slide. So I actually explained a bit on sell and buyback, but we will go through this slide. Sell and buyback comprises of two deals, right? Two deals: sale of a bond and a repurchase of a bond. Sale of a bond and a repurchase of a bond, right? No provision for initial or variation margin. Why? Because there's no need, because you do it at the agreed YTM. You do it at the agreed YTM. Now we did these calculations earlier, so like that they do the calculation and sell it. But with that sale transaction, you do another purchase transaction as well. So YTM can be slightly different, right? Because there is a tenor gap, no, that is number of days gap is there, no. So that is the investment period. So because of that, the YTM will be a different YTM, and the purchase price, the second leg price will be a different one. But these are considered as two outright transactions. So if we do like sell and buyback, we do it for the exact YTM that we want, because there are no provision for initial and variation margins. So coupon will be paid to the holder of the bond. That is another difference between sell and buyback and classic repos. Now earlier I said a classic repo coupon will be owned by the lender of the bond, right? Lender of the bond. Although we say the ownership passes to the borrower of the bond, or in that case lender of cash, right? In that case lender of cash, the ownership passes, but the coupon remains, the coupon title remains with the original person. That is the person who is doing the repo, who is lending the bond, right? But in this case, coupon will be paid to the holder of the bond, right? Why it is so? Coupon will be paid to the holder of the bond. Why it is so? We use the earlier method which we learned, the price calculation, to value this bond, to get the price of this bond. So in that, you know, the coupon is also considered, right? Coupon is also considered. If there's all the coupons are considered, not one coupon. So that means you are paying for that as well. And also if there's an accrued interest, that also you will be paying, right? Now this is a bit complex. No, you can understand this is more complex way of doing a repurchase agreement than a classic repurchase agreement, right? A bit complex way of doing it. So because of that, this is not very popular here. Very popular here because the complexity of the, you know, transaction, and especially these type of a transaction you won't be able to do with the, you know, day-to-day customer, right? Because the customer will not, you know, want to, you know, get into a complex situation like this, right? But the main difference here with an outright, there won't be the two parties, both parties will not get exposed to what? The market risk here, because there's a first leg and second leg. No, this is a closed transaction. So you buy or sell, and you sell or buy, right? So both you conclude at the same time. So now say if someone says, okay, now today you do a sell and buy back, and then tomorrow if the interest rates go up, what will happen? Nothing will happen, because you have already concluded your transactions, right? So that risk is not there, right? That risk is not there. Other than that, even the classic repo, anyway, that risk is not there, no, because it is anyway a different type of a transaction. But now here, when I say buy and sell and buy back, usually outright sale or outright purchase is exposed to the market risk. No, here it is not, because here you conclude both transactions at the same time, right? So these are, although we say outright sale, outright purchase, this is one transaction, two legs, right? But only in the calculation, everything is based on the normal usual NPV, or rather the present value calculation, right? The forward price will reflect any adjustments to be made. So the forward price will reflect any adjustments to be made, in the sense, so the adjustments are the, you know, adjustments are the ones which will happen because of the period, because of the number of days of the investment. So that is the only adjustment. So it will reflect in the forward price. And also this forward price, in the sense, price you derive from the period as well as the YTM. No, so the YTM will be the deciding factor for the price here, right? YTM. And now usually when you do this on the same day, market rate, someone can say okay, we use the same R. No, there will be slight different R. That is the rate of interest, same thing, the YTM, but now it can someone can say, okay, we can do the transaction for the same YTM, right? Or someone can do the transactions for different YTMs, but usually there will be a slight difference because of the number of days to the maturity. You know, when it is close to the maturity, right? What happens when it is close to the maturity? The rate is lower, no? Rate is lower. So, and say if you take now, it can go the other way also, but usual in a normal functioning economy, the longer tenor instruments are giving more interest in the as a percentage of interest rate, and shorter term ones are giving less interest, right? So those are the adjustments, but you need not worry about very much on sell and buyback, because anyway we don't have them in market very frequently, or other I haven't seen for quite some time, right? Now we will go to these advantages of using repos. To lender of cash. Now who is lender of cash? The person who is doing the reverse repo, right? Who is doing the reverse repo. So now if you take every day, we get customers at branches who wants to invest in repos, they say. So that means they give cash. So these investors or these customers get benefit by using repos. Now, when I say reduce credit risk, actually now we say reduce credit risk, but if you use use government securities as the security, then we can consider as zero risk, right? Zero risk. But maybe you use some other security, there can be some sort of credit risk, but now in repo transactions we usually use government securities. So reduced credit risk means now there's no credit risk at all in government securities as we consider, right, for different calculations. Collateral is adjusted to market fluctuations. We did this, we discussed this earlier. What are market fluctuations? Market interest rates, right? Market interest rates. So when market interest rates go up and down, the collateral will be adjusted. Now, now I actually stress the point that when the market rates go up, the prices will come down, and the security value will and the security value will come down, and due to that we need to top up securities, or we need to transfer more securities to the customer. But if you take the other side of it, if the security values go up, in a case if the market rates come down and if the security values go up, the bond value of the bond which we gave to this customer, repo, if the value goes up, what happens? So then we will be taking back some securities, right? We will be taking back securities. We don't need to keep the securities with the customer unnecessarily. We don't have to keep more securities with the customer. But the point here is, if you keep more, it is not a problem with the regulator. Because it is the direction, according to the directions, we have to adequately cover the transaction. But if you keep more, it's at your own risk, right? The bank's own risk. But if you go below the required amount, then that is actually can be a serious violation, right? So two sides are there. So the institutions or banks, they adjust this. They have to do it every day. You have to revalue the portfolio. You have to revalue the security portfolio given for repos, and then rather you revalue the repurchase agreement portfolio and see whether the repos are adequately covered by securities. If not, you have to transfer more securities to the customer accounts, right? And this is more flexible and liquid. When I say more flexible, why do I say more flexible? I mean, you have maybe overnight to 365-day repos, right? So it can go beyond 365 even, but not very popular. But now, as and when you want to, have a repo, you can do the repo in the point of investors, right, or customers. The customer will think, okay, I want to do a report today, so it's very flexible, right? And highly liquid. Why do we say highly liquid? Because anytime you can use those securities to now say the institution who has given you the securities, if they are not in a position to pay back your money, then you have the securities, so you can get them liquidated in the market, or you can keep them and get money at the maturity. Then those options are there. So we call government securities as the number one liquid asset, or rather the cash is the number one. I mean, the notes and coins are the number one, but in investments, the government securities comes first as the liquid assets. So flexibility of investing in different periods is there, and also highly liquid, gives access to the government securities short term. This I mentioned earlier also. This gives access to the government short term. Because you can have overnight repo and have government securities overnight, and this that gives you you go back to the earlier point, high liquid asset, and flexibility is there. So gives the cash lender the opportunity to exploit potential movements in the market. So cash lender will get the opportunity of the prices, actually, the market rates. So depending on the market rates, the cash lender also get the rate. So if the rates go up, he will get the right. And we will go to the next slide. Now these are the advantages I explained to the lender of cash, right? So the lender of bonds. Now lender of bonds also get some advantages. Lender of bonds can earn income on securities held. Now if you have a bond portfolio, right, it gives you interest income, and this portfolio is highly liquid. But you can't, if you don't want to sell this, you can't make use of this money. Your money is tied on this, right? And by doing a repo, right? By doing a repo, you generate funds on these bonds, and you can, you can make new investments with this money, right? You can make new investments. This money you get from doing repo of these bonds, right? So that is one advantage, and can reduce funding costs. Why do you say funding costs? Because now you are giving government securities which are having zero credit risk, So then now this Now, this interest rate is comprised of the base rate plus the risk component, no? So this risk component is not there. So you can, generate funds at a lower cost, right? People would like to give you money in return of, government securities, because government securities are more secured way of investments. So rather than going to the market, maybe we will, if we discuss, if we take some other example which is very relevant to you all, if we try to generate funds through call money, right? Call money rate is higher than this, right? Call money rate is higher than repo rates. So then if you want to generate funds through deposits, right? So you have to pay a higher interest rates than repos. So if you take any other instrument, even like, you can take, except for, current accounts, any other interest, now current and savings, having savings, of course, lower rate, and current is not attracting any interest. But other than that, these long-term funds or even short-term funds are more costlier in other instruments. So here in repurchase agreement, the lender of bonds will have a lower funding costs. He has access to short-term funds, lower funding costs, as well as he has short-term funds as well, right? So these short-term funds only will earn more income for him, like we explained in the first point. And although all these things can be done with retaining the title of the security, right? So because it is anyway, you don't sell it, you will be getting it back once you pay, right? So say suppose you sell it, and if there's a sudden, say, okay, without doing repo, if you sell a security to generate money, right? Say suddenly if market interest rates come down, right? You will be regretting, because your value of the security you sold now had gone up, right? Now will go up in its value. But now doing repo and doing, making generating funds and making money, there's no risk for you, because risk for you due to market, favorable movement in the market, because you have the title of the security. So if the value of the security goes up, you always can pay your repo money back and then get the security, and if you want, you can liquidate it, right? Then security is denominated in one currency for the cash requirement of another currency, right? Now here we don't find this, but in international markets, you can lend securities. You can lend US dollar securities and get cash sterling pounds, right? So that is also an advantage to the lender of bonds. So these are the the benefits for the bonds. And I have actually just a minute, I missed one slide. This I was doing this, so this calculation, same thing but different, different this thing. So we will do this calculation, finish this off. We have about, say, maybe another 5 minutes we will take. So now repo interest calculation is like this. Now cash value of repo, LKR 100 million, interest rate is 5.2%, right? Tenor, we will say overnight. Overnight means the number of days is 1, right? Overnight. Because why I took overnight repos are the most, like, we have plenty of overnight repos. It can go up to, there's no hard and fast rule that you have to do overnight. As I explained, it can go up to even 2 years sometimes. But nowadays you don't find very long term repos also, because the interest rates are very low, and always we think when the interest rates are low, we think to put in short term, thinking that in future the interest rates will go up. So it's a different topic at altogether. So tenor is overnight. Security offered are treasury bonds, right? Why I said security offers are treasury bonds, because I wanted to use the day basis of treasury bonds. It's a simple calculation: 100 million into 5.2%, right, divided by 365. So the interest component is 14,246 cents 57, right? 14,246.57. So you borrow money, you get money 100 million, and tomorrow you will be paying 100 million plus this 14,246.57. So this is actually a good option to avoid money idling in organizations. Now we have these corporate customers. They will calculate their cash flow every day, and they will put all excess monies in repo investments. So that generates them money, right? Because now early days, people were not very bothered about these generating funds from short-term funds, because they have, maybe tomorrow they have a payment, but today this is just idling in the account. So today you make this investment and you get the interest for that. So this is the calculation. Now if it is for 10 days, now if the repo is for 10 days, you multiply this by 10, 14,246.57 multiply by 10, then it will be 142,046, right? So basically I will cover this haircut policy and how do we value securities tomorrow, and then we will be finishing this lesson, and hopefully we will be able to start the settlement process by tomorrow, right? Settlement process in the sense, how do we settle securities in the SSS system, and how do we allocate securities. And I will explain maybe a few examples with regard to outrights and repo transactions. So I will finish my presentation for today. If you have anything, anything you did not understand, you can ask me now. Any questions?
What is the current interest rates on the 1-year repo, Mangala?
Overnight is going around 4.9, like 4.98, bit below 5%. Bit below 5%, 4.98, like.
If it is for a period of 3 months, 6 months, or 1 year?
So then it will be a bit higher. Maybe we will be giving around maybe 5.5 or so. I can't really remember the yesterday's rate. Overnight is, of course, we did some at 4.98.
And the retail customers also can do this, right?
Yeah, retail customers also can do. Yeah, any customer can do. We have a lot of retail customers who are coming through branches. There are actually some customers, because these now I haven't seen any growth in this market, Mr. Ratnayaka. Now I have been working in this area for last 19 years, right? 18 years, and I have been in the banking sector for last maybe 33 years. It is more or less the same volume we are doing, right? Now these days, of course, it's bit less actually, right? So there's no growth in the government securities market, right? Maybe there's what I say is not in rupee terms, but in number of transactions, right? That means the participants are there. Maybe those all 100 participants only are there, right? So they do transactions in high values, right? But it is not it is not it is not popular. Now it's not good to say like this, but the bigger truth is just give me a minute.
Okay.
Hello. Yeah, Vasanta, sorry. Yeah. Oh. All right, that's good. Virtual lang enna puluwan. Kiyada. All right. Right. No problem. I will join. That is Pizza Hut. Mata Vinali Padan, I'll call you. I'm at a discussion small. I will call you. Give me 5 minutes. Veggie. Yeah, veggie. I'm a vegetarian. Right. That's it. Maybe. Right. Sorry. This what I say, what I was telling is now banks and other institutions which are driven by the deposits, right? They are not really actively, promoting this product, Mr. Ratnayaka.
Yes.
Including ourselves, right? That is why it is not, because now the product is there, right? Because these are actually not coming in now. Now all the banks, all the institutions have performance based systems, no? So we are worried about our deposit base, right? Rather than so these are not coming into our deposit base, no? So because of that, even the branches, the branch managers, all these people are they are just trying to grow their deposit bases, not the government security market. And the very it is very easy because in here now, although we talked about this credit risk, zero credit risk and all, our customers are also driven by high interest. No, they are not bothered why we pay high interest, right? Now we pay higher interest because we can't keep our deposits at the zero interest zero risk level, no? So zero risk interest rate plus the the calculation of the plus the risk component, right, which we pay for the risk they are taking. But that is immaterial because the banking sector is so strong here, and they are very stable. The banking sector in Sri Lanka is very stable, no? So there's no risk, like then people won't think like that. There's no actual risk. There's no risk. So they are getting the only deciding factor is whether you invest for 5.2 or whether you invest for 5.7, right? Something like that. Whether you get 9% or whether you get 12%. So people go for 12%, and so that is the wish of the institutions as well, no?
Yeah.
So because of that, I haven't seen, although the values have grown up, because now anyway the values are higher, no? We are paid higher salaries than those days. So like that, everything, the value of the products also have gone up. So like that, the value they invest have gone up, but the number of transactions are actually not grown with the time.
So does the retail customers also have to do the master repo agreement?
Yeah, they have to do the master repurchase agreement. Retail customers also have to do master repurchase agreement. Only thing, in corporate customers, we exchange master repurchase agreements. That is, we sign and they also sign on the same, and then they return our copy. And actually, 2 sets will be there. So, but in case of retail customers, we won't, exchange master repurchase agreements. We sign, and if they want, we can give them a copy of that. That's it. Otherwise, everyone has to sign master repurchase agreements if they want to enter into repo transactions. And actually, the regulator, they check this, and all these audits also, they check whether we have taken master repurchase agreements. So one time when they start, it's one document only. So we will meet tomorrow. Everyone, thanks for listening. So if you have questions, you ask, like, when you ask questions, we can, I also can, explain. Now I have gone through a lot of theory today, right? Which I really don't like to do, but since I need to tell you about the repo features and all, I was forced to do that. But then I would like to discuss with the market practices and what we really do in the, in this market. That would be very much contributory thing for you all, because we all work in the same market, and we all have to practice those market norms, as well as we have to abide by the regulatory rules and regulations, and also we call them directions, right? So please ask questions. Nothing is nothing is no question is a less important question, right? Every question matters, because sometimes I may miss a point, which I will realize now when Mr. Ratnayak ask me about the whether the retail customers also need to get, then only I realize that I missed that point, right? Because now I always have sometimes in mind that I am talking to a group of people who are really in this market, no, right? So sometimes certain aspects maybe without thinking, I will omit. So if you ask questions like that, it will be very really beneficial for even for others. So ask any question, right? So about this calculation even doesn't matter. So that is why I that this is a simple calculation, but I want to show it. So that's why I put it in this slide. So so anyway, thanks for listening. We will stop now, and we will start tomorrow again at I will let you know the time. Sometimes tomorrow I won't be able to start at 3. If possible, we'll start at 3:30. Otherwise, we will go to our usual timing.
That is 4:30.
Yeah, 4:30. I will anyway let you know, Menaka, in the morning.
Right.
You and Mr. Ratnayak and Menaka in the morning.
Right.
Right. Okay, thank you so much.